we are moving forward to navigation of political risk in a volatile world. And now I hand over to the panel moderated by my colleague.
So a very warm welcome to our political risk panel. So we've just been talking about credit risk, but of course political risk is increasingly a feature of the contemporary world. Every company that has a supply chain that crosses a border, every company that has a customer that's across a border, every company that has a subsidiary that's across a border, or even stocks of inventory across a border, every company like that is exposed to political risk. Back in the early 90s of the last century, after the Berlin Wall came down and after the Soviet Union ceased to be, a lot of people were saying that political risk wasn't relevant anymore in international trade. You might remember that Francis Fukuyama said that it was the end of history. Well, those predictions weren't correct, and in the last few years, we see an increase in political risk everywhere. And that's really why the timing of this panel is apt, because political risk has most definitely increased in recent times. So we have an excellent panel with me to discuss this, people who are directly exposed to the world of political risk insurance, and I'm going to let them introduce themselves now. So let's start off from Paris, where we have George Bellord. George, would you introduce yourself to the panel?
Oh, you dropped me in it. I wasn't expecting to be first. I thought you would have asked Marian to introduce herself. But yes, good morning, everybody. Sorry I couldn't make it, but cost-cutting and time constraints, I'm afraid. Not really cost-cutting, but time constraints. I'm a credit and political risk insurance broker based here in Paris for BPL Global, and I've been doing this job for 28 years, and it's getting more and more interesting as the years go on. We have a lot of work at the moment and have gone through a number of, the crises that the world has known, and are still optimistic about the future of the industry, political risk, and what we're doing here.
Thank you, George. So welcome again from Paris, and thanks for joining us. So next I'll turn to Kyle.
Hi everyone, I'm Kyle Edwards from Atradius. I'm a senior underwriter and recoveries manager for the special products division at Atradius, where we concentrate on single situation and political risk type policies for customers.
So your day-to-day life is involved in workouts of potential claims, right?
Yeah, pre and post claim scenarios. So that's where my role. That's my role at Atradius, to work with insureds before the claim occurs, to help them with the claims process, with our claims department, and then post loss, obviously with recoveries.
Excellent. So George is a broker, brings in the risk, and then there's a claim, it comes on your desk.
Yeah.
Excellent. And Marian.
Yeah, good morning, everyone. My name is Marian Berden. I work for SCHUMANN as a business expert, and I head up the London office of SCHUMANN. My background is in credit and political risk insurance, though, where I've worked before joining SCHUMANN for about 17 years.
Okay, so let's start with you, Marian. We said that there's an increase in political risk right now, which obviously there is. Why is it happening?
Well, I think the volatility or the increased risk that we're seeing at the moment comes from a global rebalancing. And I think we're seeing a bit of a shift of the global powers. It really came to light earlier this year. We all know, end of February, Russia invaded Ukraine, a war started there. And I think for a lot of us, it was a bit of a double shock. Obviously, firstly, horrific events that happened, and we didn't expect them. But then also the response of the world was somewhat divided. In the West, we had strong condemnations and action against Russia, still ongoing. But we've seen a lot of big countries in the world taking a more neutral stance. China supporting Russia, but a lot of large countries didn't condemn the war so much. And I think that's part of a broader trend that we're seeing at the moment, a bit of a rebalancing. In recent decades, the US was the global superpower, global police officer, leading in all fields, economics, finance, military, culture, really setting the scene. But over time, we see that lots of emerging markets have emerged. They've become much stronger. They've become bigger players on the global scene, in food, in energy, in tech, economically, of course, as well. And that just means there's no one country controlling everything that's happening in the world. We see much more balanced interests, and that comes with some more risks and volatility, of course. Countries, but also companies, have different stakeholders, and you all know managing more stakeholders takes more time, and there's a bit more risk, obviously, if you get it wrong, upset someone. So I think that game of chess globally has become more difficult. And we all need to think better about political risk and what can happen, deal with volatility, and also think about narratives, where countries are coming from, their history, the decisions they make. And it's really come to the forefront this year, and I think that's why we see it and feel it's more. There's more political risk, more uncertainty and volatility.
Okay, thank you. Very interesting. So let's go over to George. So BPL, I guess, has been seen as the leading political risk broker for 39 years now, I think. What do you see with your clients, George? I mean, what political risks do they see and identify, and what is their motivation for coming to you?
Yeah, thanks, Mike. I mean, the world has been living through some very odd years. We were all extremely worried. Well, first of all, Brexit has been a major annoyance for a lot of us. But I think COVID, for example, actually brought out the good side of people. I think everybody was in the same sort of dire straits that when there were problems between buyer, seller, etc., people tended to actually sit round the table and try and sort out the issues rather than going straight to the jugular and calling the policies for non-payment or pre-shipment losses, etc. So during that period, we were all stuck at home, but people were working extremely well together in order to avert these issues. Now, everything, of course, has been exacerbated, as Marian said, by what happened on the 24th of February and everything that's happening since then. So we're actually seeing and have seen, since about 2019, a big increase from clients coming to the insurance market to try and mitigate their political risks and their credit risks. There has been, I must admit, maybe a slight shift. BPL's exposures over the last 2 years, I mean, I was looking at them back in 2019, so that's 3 years, were about $45 billion if you add all of our policy limits. Today we're at $65 billion. So we've increased the amount of policies bought from the insurance market by $20 billion since pre-COVID. Back in the olden days, our largest exposures were places like Angola, Russia, Brazil, India. Today, things have changed. Of the $65 billion, about $16 billion, so the highest country, sorry, $6 billion, I've got to get the numbers right, is the USA. The second country where people insure is the UK, followed by France. And the first emerging market would be Ivory Coast at about $1.7 billion. So there has been a change away possibly from emerging markets into our parts of the world. But at the same time, I think the insurers have, there's been a sort of flight to quality, not only from the risk perspective, but also from the perspective of who you insure. And you hear it more and more in the market. It's not what you insure, but who you insure. So the insurers are really looking at who their clients are, who they want to support into which territories. So it's actually quite difficult today, if you're a novice in political risk insurance or credit insurance, to come in and actually buy policies off these underwriters. There's a lot more work that has to be done at the front end because insurers just don't feel the need, I think, sadly, to onboard new clients. You'll all know, those that have had experience in the insurance market, the sheer volumes of inquiries. A small underwriting team in London can see 8,000 to 10,000 inquiries per annum, and that's between 4 people. So and that increases 10 to 15% every year. So there really is still a huge demand, and I think the problem is possibly on the supply side at the underwriters level. If you're a top-tier client, you're in a very lucky position where the insurance market will carry on supporting you. But it's a lot more difficult for the smaller minnows, the new boys or new girls on the street, to access the capacities, I find, and the support they require and need from the insurance market. So that's where we are spending a lot more time today, is to bring new clients to the market, but to try and sell the client to the underwriters.
Very interesting. Well, thanks, George. And I think I'm going to come back and follow up on some of those later. But before we do that, let's turn to Kyle. So have you actually seen, we're talking about, we see on the TV an increase in political risk. Are you seeing it actually translated into claims and potential risk notifications?
Yeah, I think, in terms of the claims environment in the market and the sector, it's hard to look past the war in Ukraine. George mentioned that, the claims volumes for the market had been fairly low during the COVID pandemic, as you mentioned, with businesses working together and sort of working through solutions. For the political violence and expropriation type policies, those type of negotiations can't be held. And, once a missile is launched, then, the sector is looking at a claim on their books. So there's obviously been an increase in those type of claims in the market. Looking past the sort of direct impact of the war on policyholders, we look at claims that are coming from, or potential claims on the horizon, coming from the actions taken by Western governments with increasing sanctions. Again, the first sort of claims that come to mind are where either customers or suppliers are based in Russia, where the sanctions that are being imposed are not allowing either the customers or the suppliers to fulfill their contracts. So those are resulting in claims and potential pre-shipment risks for businesses. And then,
so would that be potentially a valid claim then? If I was an exporter exporting to Russia, and then that export is sanctioned?
Yeah, obviously if the policy was taking place prior to what the things that are ongoing now at the moment, but yeah, as long as it's in the policy wording, embargo clauses of loss are included in those policies. Those are the sort of obvious examples of claims that are facing the market. You need to look past that, and I think it's important to sort of raise the awareness of businesses to look further into their supply chain, where businesses, you might not be an entity within Russia, your direct customer might not be an entity within Russia, but further down the supply chain, a major component for something you're manufacturing may come from Russia. So those goods are being sanctioned, not being able to move into the supply chain. And
so you mean you could be a UK manufacturer, and just because you've got a little component that came from Russia, that's going to be an issue?
Yeah, well, you're forced to consider delays in the contract as you look for alternatives for that particular component, potential increased costs where you're looking at that manufacturer for that component to do it over a short time period, and in a different country is going to be increased costs as well.
And so would that be claimable then if you were in that situation and you had a...
Obviously, it comes down to the policy wording again, but that's where BPL would step in and manufacture a policy that's suitable to cover the risks where that you wish to consider. But yeah, of course, those type of costs are considered to be part of the wider package offered by insurers.
Do you think that most companies are even aware, if they're making bespoke goods like that, do you think most companies are even aware of the source of every little component in a very complicated machine?
No, I think, the world has been fairly stable up until more recent times. So I think businesses have become complacent, and there's been a concentration of their supply in certain countries. And obviously in times of disruption, those type of concentrations opens yourself up to risk.
Right. Interesting. So, I mean, it's quite concerning for any company that's manufacturing that you've got this issue that you might have some sanction piece that you don't even know about. Marian, if you were advising a board of a company that was looking at its supply chain or deciding whether to incorporate a particular country in its supply chain, or thinking about an investment in a different country, I mean, what advice would you give to the board, given what we've just said?
Well, to start with, obviously the very obvious: do your research, try to understand where you're going. Use obviously local presence, local knowledge to understand the business and the market. But I think at the moment it's incredibly important that you look at diversity and buffers. We live in, as I said, a more volatile world. There'll be some more wobbles, so that you're not too dependent on one place. You have that diversity. You can maybe switch if something goes wrong. So that's really important. And obviously there's that element, the insurance market is there. You can buy that protection. So you really cover your risk very comprehensively, because as we said before, the world's not as stable as it was. It will probably be a bit volatile for the time to come, and as a business you need to make sure that you protect yourself from different angles and use the tools that are there. But as I said before, so really think about also where you're going, the country, the background, the narrative, and follow the news obviously as well, as difficult as it is to look in the future at the moment.
Right. So normally when a company is making a decision about its supply chain or any type of partnership, normally the main thing that's discussed is the financial modeling, right? So you're gonna maybe do some financial modeling. If it's an investment, you look at the return on investment. If it's a manufacturer, you can look at the cost and how that affects your profitability. So are you saying that there should be less discussion about that and something else brought in?
Not necessarily. Don't go for the cheapest place. Think about risk, risk and return. Because we see it now. We see companies have in recent years run into issues with supply chains if there have been disruptions, and they were using just-in-time, very cheap manufacturing, but not leaving them any buffers. There is a cost implication in all this, in increasing the buffers, protecting yourself against the risk and diversifying. But it is important, and we've really seen that in recent years. For things not to be too lean, we need to, while we find that balance, have slightly bigger buffers to protect ourselves.
So having less lean supply chains and more diversity and more buffers, won't that cause inflation?
It will cause inflation. It will drive up costs, but obviously diversity from a risk management point of view is also a very good thing as well. And I think markets will adjust also, but yeah, there is a cost implication.
Okay, thank you. So you've got...
You might have seen this morning, Apple are moving the production of the iPhone 14 from China to India.
Right.
Now everybody's aware of these issues of supply chain, and it is going to increase costs for all of us. But I think it's something that the world is prepared for. It's the end of the time of abundance, and we've just got to. There's going to be a lot more manufacturing being done in our countries, possibly less in emerging markets, in order to get around these supply chain issues.
So, George, now let's imagine our hypothetical board who are looking at their supply chain or their new customer or their investment, and they've had the discussion that Marian just mentioned, and they've considered political risk in the proper way, and then they decide, well, I'm going to buy a political risk insurance for the first time because I'm now aware to this, and they come to you. Now, you just said that these novice companies are going to struggle to get capacity. I mean, how would you help them?
Oh, it's what we do every day. If you speak to, I used to speak to an old friend of mine who was an underwriter, and he would say 25% of my risk assessment is who is the customer, 25% who is the broker, and then the other 50% is actually the underlying risk. So I think my role is to create partnerships between the insured and their insurers. And what we need to do is explain to insurers who the client is, what they do, what's the specifics about their business, why the insurers need to spend some time to understand the particularities of company X, Y, or Z, and give them the capacity that they need to help them finance their expansion, their investments, their supply chains, etc. As I said, it's for an insurer, it's very easy to turn something down. No insurer is going to get told off because they didn't write a risk. That's the easy solution. So we basically have to explain to these people to spend some time, which is difficult for them because of the sheer volume of transactions that they're looking at on a daily basis, and sell the merits of the risks. It's not just an email or a phone call. It's sitting down with the underwriters. It's making presentations, going to explain what the company, this company makes widgets. This company makes something else, and this is the specifics of it, and just so that the insurers get to know and understand what the rationale is for buying the insurance. Historically, insurers, I think, used to see themselves as a sort of market of last resort. If you can't find any solution to mitigate your political risks or your credit risks, well, you go and see those poor underwriters in Lloyd's of London because they'll write anything for a price. I think that's not the case anymore. And people do see the value of the product, and the larger buyers who are spending, $150 million of premium, and who've got $15 to $20 billion of exposure to the insurers, understand that and see the purchasing of insurance really as a partnership. And we've also, we've had, the proof is in the pudding, because it's all very well. It's very easy to go and buy an insurance policy. Anybody can do that. You just get your checkbook out. But the devil really is in the detail, as Carl was mentioning earlier, with regards to sanctions clauses, exclusions, warranties, etc. So it is important, I think, to be supported by experts or knowledgeable people in this industry that know what can be done and what can't be done. And I think the role of the broker also, a good broker, our role is to defend the interests of the insured. We are by law the agent of the insured. But we must also be in a position to tell the insured, sorry chaps, you're wrong. On this particular thing, we can't, the market's not there, we can't do it. So go back and to put your thinking caps on and see if we can't do it a different way around. So there has to be, I think, this sort of, I like having a sort of triangle where you have the manufacturing company, the insurers, and the brokers, and we sit down and discuss it, explain it. But it does take more time. Back in the olden days, in a soft market, people would say you could take an insurance policy into Lloyd's of London, throw it off the third balcony, and by the time the policy hits the ground, it was 100% placed. That's not the case anymore. We're using we walk around, we go and see these people on a daily basis, talking to them about different transactions. Now, we are experts in the product. we may have a certain expertise in a particular sector. It might be banking, it might be commodity trading, it might be manufacturers, etc. But we will never be the experts that our clients are. So I think it's really important to get a discussion going between our clients and the insurers, because the clients are the best people to explain their risks to the insurers, and the insurers can then explain their perspective, why they don't want to do this country or they're happy to do that country. And I remember a client of mine before, back in the olden days when things were easy. We would organise a meeting, go and see the insurers in London over a couple of days, and discuss with the insurers where they had appetite. And that was at the beginning of the year, before the particular company would send their commercial salespeople off around the world. So at the beginning of the year, you knew that there wasn't any point sending anybody to Venezuela, for example, or Cuba or wherever, because there wouldn't be any insurance support. But there may be more support in, I don't know, Papua New Guinea, or somebody had some real interest in helping out in I was going to say Zambia, for example. So you can actually help, or with the help of the insurers, possibly discuss at the beginning of the year and before you start budgeting where you should be going out to looking for your export contracts. Otherwise, as I used to say, your commercial people go out all around the world, come back with tons and tons of MOUs, which is all very well, but these MOUs need to be insurable and bankable. And if they're not insurable and bankable, well, you're going to get MOUs and air miles. But air miles don't feed your family. You need signed contracts. And that's where you need, I think, the support of insurers and specialists in this area that can help you to go to territories and cover the risks in some of the places that you guys are traveling to, or that the exporters are traveling to.
Yeah, so just to add that, and I'll say something that you can't really say modestly, George, but you said that the underwriters actually do vary their risk appetite depending on who the broker is, which might surprise some people, but it is true from my own experience that the what you know about the broker that's bringing the risk through the door has a big impact on your appetite. So if there are any companies out there who are thinking that they might need some political risk, perhaps the first most important piece of advice is to get a good broker and make sure it's a broker that has a top reputation in the market, because that will give you by far the best chance of getting your risk placed as a novice insured. Turning back to Kyle, George mentioned at the beginning about how nice everybody was through COVID, but you were telling me that you actually had a bit of an incidence where the kind of political actions around COVID actually complicated the case for you.
Yeah, there was a claim in a European country. The claim was paid out, but we were working on repayment plans and restructurings for debts. And the obligor was leaning on COVID laws put in place by the government. The restricted, the sort of winding up petitions that you could put in place on obligors. So obviously they were much more attuned to the local laws than others, than the insured and ourselves at the time. So they lent on those COVID laws to give them more time and to essentially leverage their position and the repayment plans, knowing that us as the insurer and the insured had very little option other than to sort of have those discussions and elongate them over time.
Yeah, interesting. So during COVID, governments took some very fast decisions which had unintended consequences.
Yeah.
There. Any other juicy claims you've got on your desk you'd like to tell us about? Because it's these real stories we want to hear.
Yeah, in terms of claims as a result of sanctions, we have seen some pre-shipment claims come over our desk as a direct result of sanctions with goods that were meant to be supplied into Russia. And obviously, because of the imposition of sanctions, this was in the oil and gas sector, so manufacturing components for the oil and gas sector. So where goods were meant to be supplied into Russia, the imposition of sanctions prohibited the supply of the goods, and therefore triggered the cause of loss under the policy. And the claim comes to us in terms of the pre-shipment costs that were experienced from the customer.
Good. Yeah. And with public buyers, have you seen any action there?
Yeah, interestingly, public buyers, not as a result of the war, and most of our experience on public buyers come, pre-COVID and even before then times. I guess, important to note on public buyers is it's actually protracted defaults that we've seen claims on public entities, with the main reason being, a lack of budget. And government entities blame the lack of budget for not being able to pay under contracts. These sort of reasons for lack of budget is often exacerbated during times where there's a change in government, or a change in policy. So it is open to risk at all times. And again, in South America, we saw there was protracted defaults as a result of, corruption within the government, with, embezzlement of monies by officials.
Well, the budget had been embezzled.
Yeah, from the contract, yeah.
Yeah. Okay, nice. So,
I mean, unlike credit risk, political risk, it's a lot more difficult to predict. If we knew where the next, big political risk event is going to happen, we'd be, would have a very, I'd sell the crystal ball for a lot of money. But you don't know, and this is where I think companies are actually taking a different view to pre-COVID or pre-Brexit even, where, you used to only insure the really, look at your portfolio and look at insuring the really rubbishy things, because that's where you had a practically dead cert that it's probably going to go wrong there. Now I think companies are taking a step back and going, well, hold on, we've got this portfolio or this spread of risk. Is it not a better idea to try and mitigate more of them across the board? And they're coming to insurers and they're looking at at investment insurance on portfolio basis. They're looking at credit insurance on portfolio basis. They're looking at political risk on portfolio basis. And the insurers actually have appetite when it is on a portfolio basis because because of the spread. It also often makes it cheaper in the aggregate. So the times are changing. We're talking, we were talking to risk managers. We're talking to, we talk a lot more to CFOs than risk managers, and all of the financing banks as well are looking to mitigate these risks. It reminds me of 2008, the global financial crisis. The only people that were taking risk in 2008, all the banks, the syndications desk closed up in 2008, and the only people that were still taking risk were the insurers. And there was a huge increase in demand. And I think what we've got to make sure today is that the demand is there. We've got to make sure that the supply is there. And that's where, discussing with your insurers about projects at an early stage, but also when you have an insurance policy, come to the insurers when there is a problem, as quickly as possible. They will have expertise, they will have knowledge, and potentially be able to help you out or guide you in surviving or surfing through the crisis at hand in a particular country or a particular buyer, etc. I think it's so important that you insist on this dialogue between underwriters and clients. It's very, very important nowadays.
Yeah.
You don't buy a policy and just forget about it for 3 years.
Yeah.
It's a daily activity.
Yeah, that point of partnership that George has mentioned is really key in terms of, the claims, when the claims come in. As you mentioned, it's important to come as early as you can when you're aware of potential risks that might cause a loss in the future, that we can start understanding where that might come from. And, again, a fresh pair of eyes on a scenario might provide solutions that you wouldn't necessarily think of. We might have experience in countries with the past where, the legal route is not necessarily necessarily always the correct one, and we've got contacts that we might be able to put in place to mitigate the risk before the loss event even occurs.
Right, absolutely.
Yeah, and I think some of the...
Sorry, Marian. Sorry, Marian, go ahead.
Go ahead, Marian. Yeah.
The trends you mentioned and what you've seen also comes back to there has been increased government intervention generally. Yes, it's been good. In COVID, governments have supported businesses, but it also obviously causes some disruption in markets as well and makes it more difficult to look at the future. And it's a bit of a trend, and we see it now as well with energy prices, and I think it's something that keeps coming back. I think governments in general, they take also a bit more of a short-term view, bit more fickle, the decisions, and as you say, budgets. Just everything's become more difficult to predict, and we need to learn to live with that new balance and these new trends.
Yeah. So diversity is the key.
Yeah, as the underwriters want a portfolio, I think the diversity is important for everyone involved.
Yeah, absolutely. So let's have a look at some audience questions. So here we go. Question for George. So what juicy political risk claims has BPL seen coming in this year? Can you tell us something about that?
Assets that look like tennis nets.
Assets that look like... Okay.
I mean, it's dreadful. It's dreadful to say, but the war in Ukraine is of course, there are claims in that part of the world. We've seen.
So how is the market responding well to that? I mean, is that a good story?
I think. Well, it's a great story unless you're a loss adjuster. Because as a loss adjuster, they're sent out to the country to verify that it's a valid claim.
Satellites, George. Satellites.
Yeah, I know. That's what they're doing. But yeah, the market has responded extremely well. There's a few uncertainties, possibly with regards to the aviation sector, and talking about $13 billion worth of aircraft that are stuck on the ground in Russia. But the market is here to pay these sort of claims. I think we have to put everything into perspective. Political risk is a tiny part of the insurance world. It's probably the most interesting part of the insurance world, but a typhoon or a hurricane is $4 billion. And how many of those do you get a year? If we look at our exposure in Russia, Russia and Ukraine, because of what happened in 2014, the exposures had decreased quite considerably. All the sort of financings, etc., into Russia. We only had about $850 million of Russian exposure, and about 560 in the Ukraine. And a lot of those exposures are still coming down. But juicy claims. We've had credit losses in Western Europe, where financial institutions have preferred to sell the debt at a discount, and insurers have been extremely proactive in participating in financing their share of the discounts before a transaction goes wrong. All of these policies, of course, do remind everybody that when you buy one of these policies, they're confidential. So, don't go and talk to people about political risk insurance or the fact that you bought it, or credit insurance for that matter. But, just to give you a rough idea, BPL's been around since 1983. From 83 to 2008, we had about $650 million of claims. From 2008 to today, we've gone from $650 million to about $3.3 billion of claims. So claims happen.
No wonder Kyle is so busy.
Yeah, well, but the same thing. If you look at the loss ratios over 40 years, they're only about 35%. So in our area, unless you're talking, political violence is difficult because the asset is blown up, etc. But credit claims, there are recoveries. And insurers are used to seeing boats sink and airplanes crash where there aren't any recoveries. Yep. There are recoveries in these situations of credit insurance.
Lovely. Well, thanks for that, George. We're out of time now, so I just want to thank all of you on my panel. Thank George for joining in from Paris as well. Thanks for your insights. That's been very, very interesting. Thank you very much.
Thank you very much indeed. Bye-bye.